place for a put. I think in order to understand a place for a put, we need to understand what a put is, first of all. A put is an option that will provide a floor under a given contract. That can be in the commodity space, that can be in the stock market on an individual stock. And what that put does, it establishes a floor or a worst case price. So for example, a put that in the grain industry is a tool that you would use as a producer to establish a worst case scenario price for a certain period of time. You are going to pay premium for that put, and so you could almost look at it as an insurance policy for a certain period of time, where you know that if the price of corn, for example, goes below the strike price of the put that you buy, you have protection and a short position at that price when the option expires. So again, using corn as an example, if you were to buy a corn put with a $4.50 strike price on a December contract, that will guarantee that when the option expires at the end of November, if you are below $4.50, that put will give you a short future position at $4.50. You will have a cost for that put. Let's use the example of 10 cents for that cost. So on a net basis, you will have a floor on December corn at $4.40. If we are above the $4.50 strike price, then that put will expire worthless. The loss will be the premium that you paid for it, which is the 10 cents. But the outcome is that the market is above the price that you were trying to protect, and therefore giving you opportunity to sell the physical product at a higher price than the level that you bought the put to protect in the first place. Well, you would not want to use a put if you do not have downside risk. The producer is always long. They are long whatever they have in the bin. They are long what they are going to plant. They are long what they have yet to plant in the years to come. So the market dynamics will always dictate that there is required downside coverage, regardless of whether the crop is physically there or to come in the future. The opposite of a put is a call, and a call can be used to protect the upside, and that would typically be used for an end user of a product, or for a producer that maybe made a cash sale and still wants to have some ownership potential of that product in case prices go up after they make the sale. The put option, if the price goes below the specified strike price, there are two time frames that you need to consider. The value of the put will increase as the market goes down. So for example, if futures are at $4.80 and that put has a cost, and in the example we used, maybe 10 cents. If the market goes from $4.80 to $4.50, the put will gain value. It will not gain value at the same pace that the futures move. It will gain value at a fraction of what the futures market is moving. That fraction is dictated by what is called the delta of the option. The delta of the option tells you what percentage of the futures move that the option will take part in. But most importantly, it provides you a floor at that price on option expiration day. For example, if corn is at $3.50 when the option expires in November, and that's in any given year, it'll be late November, whether it's a 2024 option, a 2025 option, a December put will always expire at the end of November in that calendar year. So you know if you buy a $4.50 put for 10 cents that you have a net floor at $4.40 all the way until the option expiration period. If we're at $3.50, that put that you paid 10 cents for on option expiration day will be worth $1. So you have an option that you paid $500 for that is now worth $5,000.